Something is happening right now, and almost nobody is talking about it, honestly. Half the financial world says artificial intelligence is the greatest opportunity of your lifetime. They say it will make the internet look like a minor invention. They say the people who don't invest now will spend the next 20 years regretting it. The other half says we are watching the largest financial bubble in modern history. They say the numbers make no sense. They say we have been here before, and they say we know exactly how it ends. They cannot both be right. Or can they? I'm going to walk you through both sides, not to tell you what to do, but because understanding this, honestly, all of it, not just the part that feels good, is the most important financial education you can get right now. Let's start with one number. Nvidia. $3.3 trillion. That is the market capitalization of a single company, one company, that makes chips. Let's put that in context so it actually lands. $3.3 trillion is more than the entire GDP of Germany, more than France, more than every business and product made in India in an entire year, combined. And Nvidia got there in roughly 3 years. Now sit with that for a moment, because the last time a single company's value climbed at this speed, in this pattern, it did not end well. The year was 1999. You had companies with no revenue, no profits, sometimes no actual product, trading at valuations that made no mathematical sense, and everyone knew it. Everyone could see the chart was vertical, and everyone kept buying anyway, because that is what momentum does to people. When something goes up every week, stopping feels like leaving money on the table, like being the one idiot who got out too early. So people stayed in. Cisco, AOL, Pets.com, Webvan, Cosmo. Names you either remember or have never heard of. Either way, you know how the story ends. In March 2000, the Nasdaq peaked. By October 2002, it had lost 80% of its value. 80%! If you had put $100,000 into the Nasdaq at the peak, by the bottom, you had $20,000. That is not a paper loss you wait out. That is a life-changing destruction of wealth. And here's the part that makes it worse. Most people did not sell. Not because they were stupid, because every analyst on television, every financial magazine, every person at their office was telling them to hold, because the technology was real. The internet was going to change everything. This was different from anything before it. They were right about the technology. They were catastrophically wrong about the price they paid for it. So here we are, 2026, and the question that the people on TV are not asking, but that you should be asking, is this: are we watching the same movie again? Because the numbers are starting to look familiar. Nvidia is up over 2,000% in 3 years. Microsoft invested $13 billion into OpenAI, a company that has never had a single profitable quarter. AI startups raised over $300 billion in 2025 alone. $300 billion. Not in revenue, in fundraising, for companies whose pitch is essentially, we are not making money yet, but we will, so please give us billions of dollars and wait. Now, I need to be clear about something. I am not here to tell you AI is a scam. It is not. I am not here to tell you to sell everything and hide your money in cash. That would be bad advice. What I am here to do is show you both sides honestly, because here's the truth that nobody on either side of this debate wants to say out loud. AI might be the biggest financial bubble in modern history, and the most important technology ever built, at the exact same time. Both of those things can be true simultaneously, and understanding how is the most important financial question of 2026. Let's build the bull case first, because it's actually stronger than you think. In 1999, Cisco was valued like the internet was going to change everything. It did change everything. Cisco just wasn't the company that captured the value. Amazon was $3 a share in 2001 after the crash. Nobody wanted it. The internet was over. The bubble had popped. Amazon today, over $200 a share. The people who said the internet was a bubble were right about the timing, completely wrong about the technology.
So the question is AI actually producing real value right now? And the honest answer is yes, measurably, concretely, in ways you can see. Goldman Sachs reported that companies using AI tools cut their software development costs by 40%, not in projections, in actual reported results. Hospitals using AI diagnostics are catching cancers at stage 1 that radiologists were missing at stage 3. That is not a press release. That is a technology that is already working. Microsoft's AI products generated $30 billion in annual revenue in 2025. $30 billion. That is more than the entire GDP of some countries from one company, from one product line in 1 year. That is not hype. That is a product that millions of people are paying for because it makes their day better. So here is what makes 2026 different from 1999. In 1999, companies were valued on page views, on potential users, on the dream of what might happen. Today, AI companies are valued on GPU compute capacity, on real enterprise contracts, on revenue that exists right now. The technology is working. Here is the bear case, and this one is harder to see because it hides inside the good news. The companies buying AI are spending money faster than AI is saving it. Right now, every major bank, every hospital system, every Fortune 500 company is running AI pilots, spending millions, sometimes hundreds of millions, on tools that are improving things, but not yet enough to justify the full cost. Salesforce spent $4 billion building AI into their platform. The productivity gains it created saved customers roughly $600 million in labor costs. $600 million gained, $4 billion spent. That is not a good ROI, and Salesforce is not an outlier. The revenue is real, the profit is not, and the market is pricing these companies as if the profit is already here. It isn't. Nvidia sells chips to companies that are losing money on AI so far. Microsoft sells AI subscriptions to enterprises that haven't proven the return on investment yet. And the investors behind all of this are betting that the ROI arrives before the patience runs out. That bet might be right. When the internet started, it cost millions to reach 1 million people. The infrastructure had to be built first. The costs came before the profits by years. Amazon lost money for almost a decade before anyone understood what it was building. Maybe AI is the same story, where maybe this time the spending outpaces the returns forever. Here is what the market believes right now. The market believes that AI will save companies $2 trillion per year globally by 2030. $2 trillion. That is a staggering number, and honestly, it might be right. But the current investment is priced as if that $2 trillion is already locked in, already certain, already guaranteed. It is not. The question is not whether AI will create enormous value. The question is whether the people who invest today will capture that value, or whether they will lose their money waiting for it to arrive. That question brings us to the most uncomfortable part of this entire conversation. If this bubble pops, and I'm not saying it will, but if it does, who exactly gets hurt? And the answer is not who you think.
Let me tell you exactly what happened to regular people in the dot-com crash, because this is the part they don't teach in business school. March 2000, NASDAQ peaks. By October 2002, down 80%. Now here is who actually got hurt. It was not the hedge fund managers. They had already sold their positions and were sitting on cash. It was not the early-stage venture capitalists. They had cashed out during the IPO frenzy. It was not the founders who made $10 million on the way up. They kept their houses. It was the retail investors who bought at the top. It was employees who took stock options instead of salary and watched those options go to zero. It was pension funds that had shifted into technology because technology was the future. Teachers in California, firefighters in Ohio, factory workers in Michigan, people who never signed up to speculate on tech stocks. They just wanted their 401k to grow. Now here is the uncomfortable parallel to today. Nvidia represents approximately 5.2% of the S&P 500 index.
5.2%. If you have a standard target date retirement fund and 80 million Americans do, you own Nvidia, probably without realizing it. If Nvidia drops 40% tomorrow, and that would not even be unusual for a stock at this valuation, your retirement account takes a hit. Not because you chose Nvidia, because the index chose it for you. That is the hidden risk nobody on television is explaining. But here's the thing. There's a version of this story that does not end in a crash. Not every bubble resolves the same way, and AI in 2026 has something the dot-com bubble absolutely did not. The dot-com internet in 2000 was still dial-up for most people. You waited 4 minutes to load a web page. You went online once a day, checked your email, and disconnected. It was useful, not essential. AI in 2026 is already embedded differently. Lawyers draft contracts in 20 minutes instead of 4 hours. Radiologists read 2,000 scans a day instead of 300. Developers report AI writes 30 to 50% of their code. When a technology stops being a tool and starts being a habit, it survives the crash. The Nasdaq lost 80%, but the internet didn't go anywhere. It just got cheaper, and then it rebuilt everything. So here's the honest answer. AI is probably both things at the same time. A financial bubble in terms of current valuations and investor expectations, and a genuine technological revolution in terms of what it will actually do to the world over the next 20 years. The dot-com bubble destroyed a generation of portfolios, and then it created more wealth than almost any technology in human history. The question is not whether AI will matter. It will. The question is whether you're positioned like the person who panic-sold Amazon at $3 in 2001 because the bubble popped, or like the person who understood that the technology was bigger than the crash and stayed in while everyone else fled. Here's the practical reality. If you're invested in any broad market index fund, you're already in this trade. You cannot fully opt out. What you can control is how concentrated you are, how much of your portfolio is riding on a handful of AI names, and whether you understand what you own. The crash might come, or it might not. The valuations might eventually make sense, or they might not. But the technology is here. It's already changing how people work, how they get medical care, how they code, how they learn, and it's not going back. The most dangerous thing you can do right now is not understand this, because whether you invest in AI or not, it's going to affect your job, your savings, and your financial future. If you want to keep tracking this honestly, subscribe. We're going to follow this together.